From the Wall Street Journal, how the housing market slowdown is rippling through the economy in 5 charts. Subhead: Following Fed rate increases, spending and job growth in housing-tied sectors are struggling. This article caveat is focused on residential real estate, a significant part of the economy, but not on the commercial real estate market, which is going to differ by segments and categories. Higher interest rates from the Federal Reserve caused the housing market to seize up this year, and that is now having a spillover effect for hardware stores, furniture sellers, and construction firms. Sales of existing homes fell to a 13-year low in October. Economists surveyed by the Wall Street Journal estimate that a report Wednesday from the National Association of Realtors will show sales fell again in November. That is taking a toll on workers and businesses that rely on spending related to the housing market. Starting off, less spending on furnishings. When people buy and sell houses, they often spend on remodeling and then on furniture once they move in. With sales of existing homes in a slump, spending on furniture and at home improvement stores has fallen this year compared with 2022, according to data from the Commerce Department. And here we see retail sales at furniture and home improvement stores change from a year earlier. We were seeing a meaningful decline in building materials, garden equipment, and supplies dealers, as well as furniture and home furnishing stores. Many Americans don't want to move and give up the low mortgage rates they locked in a few years ago, but even those who are staying put are showing a bit more caution with respect to larger projects, said Home Depot Chief Financial Officer Richard McPhail. The high cost of borrowing is leading people to put off remodeling, he said. We're also seeing lower spending hitting jobs. Less spending on housing means less need for workers in industries that are closely tied to the real estate market, including at retailers for furniture and electronics and at home improvement stores. Employment is down across these industries this year. And here we see employment in select industries, the change from a year earlier, with furniture and home furnishing retailers, building material, garden equipment, and supplies dealers, electronics and appliance retailers, all showing noticeable declines. Employment in the real estate sector, such as brokers and property managers, also has stagnated this year. Many real estate agents now are rethinking their jobs. Demand has also eased for service jobs related to housing, such as landscaping. And here we see employment in select industries change from a year earlier, covering services to buildings and dwellings, as well as real estate specifically. And again, we see some noticeable declines. Services related to housing are definitely in a recession, said Thomas Simmons, senior U.S. economist at Jefferies. Construction caution, spending on construction of new homes and remodeling of existing homes shot up in the wake of COVID-19 pandemic. As many Americans moved or sought to improve their living spaces during lockdowns, that activity has cooled as the Fed raised borrowing costs. And here we see U.S. private residential construction spending. And indeed, we do see a very steep increase going into 2022, followed by a noticeable decline in private residential construction spending, although still well above levels in 2020 and 2021, as we still do have a housing shortage in the country. Builders are held off on new housing projects as the market cooled this year. Residential building permits signal how much construction is in the pipeline. We're down nearly 30% in January from a year earlier. By October, though, they were down by 3.7% from a year earlier, a sign the slowdown may have bottomed out. Housing starts, a measure of new residential construction, also slumped earlier this year, but has gained ground since. Here we see housing starts and permits change from a year earlier. And indeed, we see them hovering around the level from about a year ago after a dip. In conclusion, Kenneth Simison, chief economist at Associated General Contractors of America, doesn't expect the tide to turn quickly for the real estate market next year. Sales of existing homes, quote, are likely to remain depressed throughout 2024 and be a downer for people selling goods and services related to that.